Hi, everybody. We'll give it a few more minutes before we get started. Good deal. Well, should we get started, Betsy?
Yeah, let's go ahead.
All right.
Well, good afternoon, everyone, and welcome to our webinar, Charting a Course to Financial Excellence, Finance and Accounting Considerations for Cannabis Businesses. My name is Betsy Morem, and I'm here with my business partner, Morem Waller. Together, we are Morem Waller CPAs, a full-service CPA firm with a focus in the cannabis industry. We're both based in Minnesota and work with clients across the country. So let's get right into it. Here's our agenda for today. We are going to discuss understanding the prospective financial outlook of your cannabis business, setting up the proper accounting systems once you're pre-revenue or pre-operational, the importance of proper accounting throughout the life of your business, and finally, everyone's favorite topic, 280E, and how that will affect your business.
And as a programming note for everybody, there is a chat available for you. So if you have questions along the way, please feel free to add them in the chat. We will be able to see them, and we'll try to answer your questions as we go through the slides. We also will have a bit of a Q&A at the very end. So please feel free to keep this as open as you like. We want to make this as informative as possible for you.
So first up, understanding the prospective financial outlook of your business. This is all around creating financial projections, which are crucial before entering the cannabis industry, or really any industry for that matter, as it provides a roadmap for the financial success and sustainability of a business. In the cannabis sector, where regulatory landscapes can be complex and rapidly evolving, accurate financial projections become even more essential. Projections help entrepreneurs like yourself estimate startup costs, operational expenses, potential revenue streams, allowing you to make informed decisions and secure necessary funding. Given the unique challenges and opportunities within the cannabis market, such as compliance costs, taxation nuances, and varying consumer preferences, well thought out financial projections enable you to navigate uncertainties, anticipate challenges, and position yourself strategically for long-term success. Additionally, investors and stakeholders often rely on these projections to assess the viability of a cannabis venture. So it's an indispensable tool for attracting capital and fostering transparency in the industry. So one example of how you might project revenue in your cannabis business. Mark, if you wouldn't mind moving on to the next slide. Here's an example of how to project a revenue. This example is for a retail location. So the revenue projection is based off of foot traffic. It takes the location market population and extrapolates the revenue based upon estimates around percentage of population that consumes cannabis, percentages of that population that uses the legal market, average visits per month, average spend per visit, and then the market share of your cannabis dispensary.
I would add to this too that one of the big benefits of putting together a projection like this is you can start with a template like this, which is a great template, and add scenarios. So you can play with those variables, things like how many visits will each person spend per month? What is the average spend per visit? What is the foot traffic? Those are all variables that you can play with. And one of the things I really like to do with these types of scenarios as well is to put together like a good, a better, and a best scenario. So you can say, what is your absolute baseline scenario of average spend? Maybe your hoped for spend is $100 a month, $100 per visit. And to be conservative, which is always important when you're putting a dispensary together and doing projections, maybe you say 60. You can think of things in the sense of your most likely outcome might be a little bit lower, but to project higher, you want to have a few different outcomes that you could look at.
Absolutely. And a huge aspect of this example is that market share. So if you're in an area that's saturated, you're going to have a smaller percent of that market share. Whereas say you're in an area where they've limited the number of licenses, you may have a larger percent of that market share. So that's a huge determining factor in your revenue projection. So once you've got your projections put together and say you've got your license in hand, you've raised the necessary capital, et cetera, and you're ready to start operating. So now's the time when you want to set up your accounting systems and procedures. That can include things such as your accounting software. Maybe you're using QuickBooks Online or Xero, your point of sale system, if you've got a retail location, inventory management system, cash management system, payroll system, etc. It's much easier to put these systems in place prior to opening than it is to wait until you're open and try and play catch up. So we really stress the importance of having all of your systems in place prior to opening, whether that be your cultivation, manufacturing facility, retail location, etc.
I would add to that as well that one of the dangers of not setting things up prior to opening is and this is an issue a lot of cannabis business owners run into. They assume that if they haven't received any revenue that they don't need to file taxes. And that's actually not the case. You still need to file a tax return with the IRS as soon as you open a business, which is one of the bigger reasons to make sure that you have these systems in place right away, rather than waiting until midway through your venture.
Yeah, that's a great point, Mark. And of course, once you're operational, the importance of accounting does not stop. So establishing robust accounting systems and procedures before opening your business is really important, but then just as important is continuing the accounting throughout. And those systems, well-designed accounting system enables businesses to maintain organized records. It facilitates decision-making and strategic planning. It streamlines the tax preparation process, reduces the risks of errors and potential legal issues. And then, of course, you've got other considerations such as potential audits, valuations of your business, banking relationships, and then of course 280E compliance. So we all know that cannabis is a highly regulated and audited industry. Non-compliant businesses can face years of litigation, legal fees, penalties, and interest with the IRS. So that's why you really need a cannabis-trained accountant to ensure accurate and compliant accounting. Organized and accurate books reduce risk and ultimately will help you save money in the event of an audit. And as your business grows, you may be subject to financial statement audits from banks, investors. So it's always best to stay on top of your accounting. And for our firm, that means that you are closing your books on a monthly basis and you're reviewing those financials on a monthly basis. So there's many reasons to motivate yourself to keep up to date and organized books. Mark, would you have anything to add to that?
Yeah, no, I think that's spot on. I think again, like what you were saying earlier, having that peace of mind from day one is really, really important, because it's a piece of your business that if you don't stay in touch with it, can spiral out of control really quickly. So it's best to just kind of stay on top of it. I do have a couple of comments in the chat. One just about the bronze, silver, and gold. I like I like that as an analogy for good, better, best. I think I think when you're doing a financial model, especially before you've even opened your doors, it's just so much smarter to do it assuming your most conservative scenario, because then you can budget your expenses. And we talk a lot about 280E here, and how it's a big scary thing, but in reality, if you budget and forecast your way into your business, you can reasonably do a budget where you can still break even with tax burdens. I had another question about, will the slide deck be made available at the end? Yes, we will definitely send this out to all participants. And are the revenue and market share figures samples, or are they based on a specific market? I think they're basically samples. So when we do look at that, though, we try to kind of geolocate where a dispensary is or where manufacturers are, and get a sense of what's kind of typical or what to expect. I would say, and Betsy, feel chime in here as well, but I always think of kind of like a healthy dispensary might have a cart size of, say, $60 per customer, and they might be generating $8,000 per day. And that's based on a dispensary that might be, in that $1 to $5 million range or so of total revenue. It's, at the end of the day, there's still a lot of similarities. So those, to me, the cart size and the total number of customers per day are really, really important when it comes to generating those figures. And then pretty reliably across the country, there are also different categories of cannabis that just take up a bigger percentage of revenue than other pieces. I'd say flower is almost always number one. Pre-rolls are always pretty high. Yeah. What do you see, Betsy?
Yeah, you're spot on. Flower, pre-rolls, edibles, typically the highest selling categories.
Yes. And here in Minnesota, we are legalizing, but we don't have a license structure yet. So while we have legal cannabis, we are not selling flower, pre-rolls, and things like that. We are selling the hemp-derived goods, which are federally legal at this point, but we haven't seen the flower hit the market yet. So I'm really excited to see what happens in Minnesota when that happens sometime in 2025, hopefully.
Few steps to go before that happens, right?
Yeah, right.
So as we mentioned earlier, there are many reasons to keep good books. One of those is valuations. So some people get into this industry to ultimately sell their business. And if that's your goal, you'll certainly want clean and accurate books, because that's only going to increase the valuation of your business. As a buyer, they're going to want to see that you've got your financials in order so that they can rely on that information to make a decision about whether or not they're going to purchase and at what price. We have mentioned here too that there are multiple ways to value a cannabis business, and really only a certified valuation analyst can conduct one with attestation included. So if you're ever in the market for evaluation, I would certainly look for a CVA to conduct that. And then we also have a good resource here on that topic of valuations.
Yeah, there's some really good resources out there, and we get this question a lot of, hey, what's my business valued at? And that's where we're a little bit limited there, because for one, the certified valuation is a different engagement than kind of doing the forecasting, and it includes much more input, much more, you know, when I say attestation, there's actually a signature involved in certifying that the results are as accurate as possible. And I would also say the state regulated markets in each state make the prices of cannabis very volatile. It's not like a commodity where the prices are the same year over year. The prices
like the price of
change
corn
quite a
that you can just look it up online.
Exactly. Exactly.
And of course, banking. So banking is always an issue in this industry. Options are limited because we haven't yet passed the Safe Banking Act. So banks who will accept cannabis clients, they often have a lengthy application process and particular compliance requirements, and of course, high fees. So for our clients, for example, we often have their banks asking for updated financials. So it's just another incentive to kind of keep things up to date throughout your business so that you're prepared to send those financials over to your banker at a request. Mark, do you want to take it away on 280E?
Sure. So 280E, it's everybody's favorite topic in cannabis. And I'll just start with defining what is 280E. When we had a session with some folks with our Minnesota-based seminar series called Canna Connect in Minnesota, we asked this question to the audience, who knows what 280E is? And actually, we asked this question as well at another event earlier this summer with about 300 or 400 people in the crowd. Who knows what 280E is? And it was a little bit scary how few people raised their hands. So if you're going into cannabis, you definitely need to know about 280E. And yes, it is shocking how few people know that, and they definitely find out quick. Yeah, that's true, Elizabeth. So what is 280E? Well, essentially, expenses that are typically deducted on tax returns for businesses are disallowed from doing so because cannabis is federally illegal. I'm just going to go over to the actual letter of the law definition of 280E and read it to you, where it says, no deduction or credit shall be allowed for any amount paid or incurred during the taxable year in carrying on any trade or business if such trade or business consists of trafficking in controlled substances within the meaning of Schedule 1 and 2 of the Controlled Substances Act, which is prohibited by federal law or the law of any state in which such trade or business is conducted. Now, I did a webinar last week with attorneys where we dug into a number of different court cases that have essentially upheld this. I'm not going to get that deep here, but suffice it to say, there are many, many, many tax court cases that essentially uphold exactly what is written here, which is no deduction or credit shall be allowed for any amount paid or incurred. So what does that mean for practical purposes? It basically means everything that a business would normally be able to deduct on their taxes, such as marketing expenses or accounting expenses or utilities or things that don't necessarily touch the production or sale of your goods, but are necessary to remain open, those expenses are not deductible, which means effectively cannabis businesses pay a higher tax rate than a typical business does that is not trafficking in controlled substances. I want to touch on this recent development because it's very relevant to this piece about Schedule 1 and Schedule 2. On August 29th, 2023, this year, the Department of Health and Human Services recommended that cannabis be moved to Schedule 3 on the controlled substances list, which would, in essence, make cannabis, it would take 280E within the meaning of this particular definition out of the picture, which could result in tax savings for cannabis businesses. There is so much to come on that development. Whether it happens in 2023, personally, I don't think that it's going to happen this year, although I did see just earlier this week that there's some talk that maybe it will. We just don't know enough right now about what's going to happen. But even if, say, the DEA, who is the one who ultimately decides on this, moved cannabis to Schedule 3, there's likely to be a whole list of challenges or interpretations or reinterpretations that we kind of want to wait until the dust settles a little bit. In my mind, we're thinking maybe in the next couple of years, if cannabis is descheduled, we may have a different view of 280E. There may be new regulations that come into place. There may be different excise taxes. There may be just other things that we don't know about right now, but it is something to keep an eye on. It's definitely, for the most part, it's a positive development. There's certainly some argument about whether cannabis should be legalized rather than descheduled. That may have kind of greater consequences on the industry as a whole. That's for another blog post. Actually, you can check out our blog. I'm going to plug our blog a little bit here, where we get a little bit deeper onto what are the actual consequences of moving to Schedule 3. What would it be good for the industry? There's just a lot of opinions and a lot of thoughts about it that are yet to be determined. As of today, November 15th, 2023, 280E still applies. So to go through an example of how 280E affects a regular business versus, or I shouldn't say regular, but a non-cannabis business versus a cannabis business. Let's say you have a business that has $2 million of revenue. You have $600,000 of cost of goods sold, and that's a key area because we can reduce your taxable income by utilizing cost of goods sold for a cannabis business. In this case, let's say it costs $600,000 to produce $2 million of revenue. Your gross profit is for $1.4 million. The SG&A expenses for a cannabis business, those are the things like your rent, your expenses that have nothing to do with the production of cannabis, would reduce your net income to $300,000. And then let's say the federal income tax rate for corporations, which is currently 21%, applies. For that non-cannabis business, they are taxed on this number, the $300K, which means that the tax that they pay is $63,000. So the net income after taxes in that case is $237,000, and their effective tax rate is 21%. In this example, and I would say this is maybe not an operation I would be all that excited about because the cost of goods sold is kind of low and the SG&A is kind of high. But if this was to happen in this way and your gross profit is 1.4 million, you're taxed at that 1.4 million rate rather than the 1.4 million of gross profit rather than the 300K of net income. So your tax that you pay is $294K, which means that you are much lower for net income after taxes, and your effective tax rate is 98%. Now, I haven't seen any real life
Extreme
examples
example.
of things. Yeah, it's a very extreme example. Typically, what we see is cost of goods sold is about 50%, maybe a little bit higher for manufacturers and cultivators. And then what we try to advise our clients to do is to try to keep these expenses as low as possible, because that also is just going to save you money. But that is certainly the one of the possible outcomes of this.
Yeah. And I'll just add to
Katie's,
that we have clients, for example, our retail clients, their COGS is usually at that 50%, maybe even a little bit less. And so their effective tax rate, their effective tax rate is not at that 98% level. And they're still successful despite 280E. So
yeah.
Try not to be too discouraged by this extreme example.
Yeah. I would say that's where I would say, yes, 280E is serious. You need to know what it is, but it doesn't have to be doing doom and gloom. And that's where I connect it back to the forecasting and projecting and planning, because it's going to be a lot smoother to be able to plan for 280E than to try to kind of think about different ways to get around it.
Yeah.
So just kind of day-to-day financial management tips that I think are extremely important to consider. First, starting with accurate and timely financials that you can rely on. I think for our clients and for our really successful clients, they understand the importance of having financials to understand what is included in them. They don't need to know all of the details, but they do need having a basis of understanding of what financials look like is really important to know how the business is performing. Thankfully, all of our clients that we work with have that interest in understanding what's happening. So that's, certainly what we want to see. Reviewing financials on a consistent basis means that you're able to make adjustments when necessary. Certainly by planning and putting a budget together, that allows you to be able to review how are you doing, and are you doing things the way that you need to. Certainly there's always room for adjusting if some of your inputs on your budgeting side don't go according to plan, but just keeping up with it is the most important thing you can do. Tracking KPIs, those are called also known as key performance indicators. Those can be helpful ways to identify trends. So for a dispensary, I love the average cart size as a KPI, and thinking in the terms of having a goal average cart size per month or per day is a good way to track, are you meeting your revenue goals. If you get really detailed, you can even look at those inputs and formulate are you going to hit your revenue goals? Because at the end of the day, if you know what your cart sizes are, if you know what you're making every day, and you know that your margins are pretty consistent, you can pretty much bank on what your revenue is going to be like over time. And then again, accurate, timely financials just makes your tax planning throughout the year significantly easier. So things like quarterly tax payments. One of the things we really like to do is when we publish our financials, we will calculate what that federal and state tax rate would be per month if you were going to be paying your taxes. So some of our more diligent clients like to take that number and just actually transfer that cash into a savings account so that they can just kind of set it aside and then pay it at the end of the year. Or if they need to pay quarterly taxes, they can do it that way as well. So finally, getting into some do's and don'ts here. So I would say do use a customized chart of accounts. So that is really important for cannabis businesses in particular, because of the nature of the cost allocations that go into calculating cost of goods sold. That's especially true for manufacturers and cultivators. So don't just use the chart of accounts that comes out of your QuickBooks or your Xero. I would definitely get something that is customized for a cannabis business. do use accrual-based accounting. You may see the word GAAP around. That's GAAP is pronounced GAAP, and that stands for Generally Accepted Accounting Principles. There's not a specific law per se what GAAP is, but there's various different accounting boards that establish what is GAAP and as basically the basis for how audits are conducted. So one of the key pieces to understand is that when the IRS conducts audits, they check to see if you're using accrual-based accounting. And if you are, that certainly helps your case when you do your audit, because then they understand that you are following generally accepted accounting principles and you don't have any issues where maybe you're not valuing things appropriately or costing things appropriately. Do use the cost accrual worksheets, especially if you're a manufacturer or cultivator. That's where I was talking about including those allocations in your cost of goods sold is vital, and being able to take those numbers from your financials and trace them to a work paper that calculates those numbers is extremely vital, because that's any auditor, whether it's the IRS or financial statement auditor, that's exactly what they're going to do, is they're going to say, show me your financials and show me your work papers, which gets into your keeping a permanent audit trail. There are a number of different cloud-based systems. I was actually just talking with somebody who works specifically with databases, and he said that cloud-based systems right now are more secure than they've ever been, that many businesses that had been kind of keeping their cloud in-house are now moving over to things like Google Drive. And certainly there's bad actors out there that you need to protect yourselves from, but the ability to keep a permanent audit trail on the cloud is certainly more available now than it ever has been. So do keep that. Do use your internal controls, because that's, again, for auditors, whether it's the IRS, financial statement auditors, any auditor is also going to request at the very top of your audit a copy of your internal control handbook. And the first thing that they're going to do is they're literally going to read it, and they're going to create tests that would indicate, are you actually following your internal controls? So don't just set it and forget it when you have an SOP or internal control handbook. Actually make sure that you're using them, because that just saves everybody a lot of time. And then don't write off non-inventory expenses. So don't go to your tax practitioner and say, hey, I feel like my utilities should be written off, so why don't you just put it up and deduct it? Don't do that. we don't like that. And same thing is, don't abuse your COGS accounts, which basically means you hear a lot about companies that are saying, well, maybe the other, my marketing expenses should be included because we wouldn't be able to sell our products without it, so let's put it in our COGS. Those are tactics that have been tried many times and in the tax courts have been rejected. So there's going to be a lot of practitioners out there who will say there's maybe different methods that you can use to increase your COGS. In my mind, I think it's better to be as safe as you can without pushing the envelope too hard. And there will be tax court cases that might bring things down, or there might be more developments of 280E that's allow for tax savings. I would not mess with abusing your COGS accounts. Betsy, is there anything that comes to mind for you along these lines?
I don't think so. I think you did a great job of laying out the general guidelines. The only thing is, I thought maybe we might give an example of cash versus accrual-based accounting.
Sure.
And how that differs for small businesses. So sure. Most small businesses are able to do cash basis accounting. And basically what that means is you can record expenses when you pay them. You can record revenue when you receive it. And because cannabis businesses have to follow GAAP, generally accepted accounting principles, they have to do that accrual basis accounting. So rather than recording revenue when you physically receive it, and expenses when you pay it, you're recording revenue when you earn it, and you are recording expenses when you incur it. So there's less flexibility with accrual basis accounting than cash basis accounting. So I think I like to explain that because the majority of small businesses in the country can get away with cash basis accounting, and unfortunately that's not the case for cannabis.
Yes.
Okay,
So at this point oh, go ahead, Katie.
I was just saying we have a couple of questions from the chat. I thought I'd read them out to you all. You guys
Sure.
can chime in. Okay.
Perfect.
Elizabeth asks, do you know what % of plant touching businesses are still operational 3 years out in some of the newer markets like Arizona, Michigan, Illinois, Massachusetts?
I can take this one. I don't know as if we know a certain percentage, but I will say what's unique about the cannabis industry is it seems that businesses either fail or succeed faster than in any other industry. So we've known of businesses that have opened and closed within the span of 6 months. And a big factor in that is maybe they're in a saturated market. You also are typically going through cash because the cost of entry is so much higher than most other businesses. You are going through capital a lot faster. And if you're not seeing sales, you're going to fail that much quicker. So I don't have an exact percentage, but that's been my observation is just that things seem to move a lot quicker in this industry in both good and bad ways. Mark, would you have anything to add to that?
Yeah, no, that's exactly right. We can typically see and with some real life examples, the businesses that start strong, a year later, they're still going strong. And these are not necessarily in big metropolitan areas, but they're in rural areas. Typically, if they start strong, they're probably going to stay strong. Yeah, the biggest issue that we've seen is when dispensaries or manufacturers open in markets where the market is starting to get saturated. And that has happened in Oklahoma for sure. It's happening in New Mexico, where there's just a number of competitors that going back to that first example, if you only have so many feet available in so many stores, then just simple math says unless you're doing something really special, it's going to be challenging. So I would love to see that though. Like, what is the actual percentage? I would imagine it's probably similar to any small business. I mean, I think I don't have the figures in front of me, but most small businesses don't get to, I think only 10% of small businesses hit $1 million of revenue, and most small businesses close within 5 years. So I would think, the same principle applies in cannabis.
Thank you. We had a question from Kevin that was, can you please confirm low-dose hemp-derived THC businesses fall outside the scope of 280E?
So yes, that is true. So because hemp-derived THC is federally legal, it doesn't fall under the scope of 280E. What we don't really know is, and this is particularly true for Minnesota, is what happens if a cannabis business or a hemp-derived business gets a cannabis license. Does that negate everything, that kind of advantage that a cannabis business has where their hemp-derived goods are federally legal? My inclination is that if you do really good accounting and are able to separate your hemp-derived production and all your SG&A expenses very, very, very well, if you're able to separate those apart from cannabis, if you end up, and this is especially true in Minnesota, where there's a large hemp-derived market, you may be able to carve that piece out where you can continue to keep that cannabis deduction available. The problem that gives me a little bit of pause is that many tax court cases have disallowed sale or income that is clearly not related to plant touching. There have been some tax court cases, including Harborside, which is kind of the key tax court case, that has said everything is in nature of trafficking cannabis in this business, even if it's not exactly selling cannabis. So it's yet to really, we don't have any tax court cases on this particular case right now. My hunch is that if you do a really good job of carving things out, I would feel really comfortable saying that you can maintain that deduction. But again, it's so brand new that we don't really know for sure. I think there's another question from Addie S. For retailers, what about vendor funding? If a vendor pays the retailer a kickback, not revenue, can that kickback go directly to the net income buckets? Are you talking about, I'm not sure if you're talking about if that relates to 280E. If it does, I mean, I think that, yes, it would increase your net income. It wouldn't be deductible per se.
I'm wondering if they're like saying giving a better deal on the product.
Sure.
I'm not super clear on.
Yeah, I mean, if it's, I think he's yeah, if you could clarify a little bit, yeah, that would be helpful. Elizabeth says, I think many projections are inflated and people cannot meet investors' expectations quickly enough as well. Yes, I totally agree. Yeah, that's where having the good, better, best projections is smarter to me. If I were an investor, I would probably rip up most of the projections I see initially until I see something that has that. Yeah, you agree, Betsy?
So Audie is saying he cannot unmute. Would we be able to unmute him so he can clarify his question?
Let's see if I can do that.
Perfect. I think somebody did it.
Okay, great.
Awesome. Thank you, guys. Hi, everybody. For those of you who don't know me, my name's Adi. So my question was relating to 280E. So let's assume that I'm a retailer and I have a vendor partnership with one of the brands. And I think in your example that you're giving us, COGS usually tend to be about 50% of revenue. So let's use that as a guideline. What if in my vendor program agreement, I basically negotiate a sell-through credit funding? So on top of COGS, so let's say COGS are 50%, I negotiate a vendor deal that says, hey, for every unit sold, you're going to give me $1 right back as a vendor funding. It's a kickback. And I come from a retail background where these principles in mature markets are sort of the norm. And I know in the cannabis industry, this is a completely new sort of a way of doing business. So that's what I'm wondering. If a vendor gives me a kickback every quarter, let's say of $50,000, will that $50,000 go directly to my net income, or will that somehow be considered a marketing, which then 280E then scrutinizes it? Do you know what I mean?
Mm-hmm.
Well, I think like would it come in the form of a check? Like would the
Yep.
Okay, so that would be revenue to the business. So if I'm thinking of it correctly in the example that you gave, that would be taxed.
Okay.
So it wouldn't it would either, I mean, if I was on the accounting side of things, I would either include it in revenue or maybe it would offset advertising and marketing or something like that. But either way, it's not going to you're going to get taxed at the normal rate.
Yeah. Even if it went to your top line gross profit, it wouldn't be reducing your COGS by a similar amount. So it's going to be incrementally higher.
Mhm.
Yeah, Shelley
it's separate
says.
from COGS.
Yeah, Shelley says it would
Yeah.
reduce your COGS and be revenue. Yeah, that would be another way you could account for it, is reducing your COGS, which it has the same effect.
Okay, got it. Yeah, the current state, at least in my experience, I work for Best Buy, Target, and these brands, what they do with these kickbacks is basically it goes directly into the profitability bucket and never even goes through the revenue. And that's, of course, finance sort of manipulating where
Right.
dollars get allocated to.
Sure.
So sounds like, based on what you're saying, it's probably going to be tied to COGS somehow, which is going to end up being taxed. Okay, got it.
Yeah.
Something to think about.
Yeah, I think there's a couple ways to account for it. Really, just I guess from like a managerial accounting perspective, where from managing your business operations, where does it make most sense to see that? Because you're going to be kind of skewing one number or the other.
Mhm.
Does that answer your question?
Looks like you went on mute, but
Oh.
Yeah, I think that's an interesting point though too, Adi, is that there are a number of different types of programs like that traditional retailers use all the time, and I don't see it as often in the cannabis industry. So we work with some vendors that do things like try to find bulk purchasing for supplies, that if you go through a bulk purchaser, you can save money there. I mean, there's just a lot of different opportunities like that are available to cannabis businesses, and especially for vendors that want to work in this industry and are comfortable with it. There's good opportunities there.
Yeah.
Gabriel has a question. I was under the impression retail businesses are more affected by 280E than cultivators and manufacturers. Retails and sales are trafficking. Production is not considered trafficking. Is this correct? Production and cultivating is also considered trafficking. So unfortunately, manufacturers, cultivators, dispensaries, they all are subject to 280E. Now, I would say cultivators and manufacturers have more potential input for cost of goods sold, because the cost of producing is a little bit more kind of, for lack of a better term, all over the place than retailers that are simply purchasing from producers and cultivators. But yeah, every piece along the line, if you are moving cannabis from seed to sale, it's considered trafficking.
I think one good thing to note too is that so the keyword is plant touching. So ancillary businesses like Morem Waller CPAs, even though we work with cannabis companies, we are not considered plant touching, therefore we're not subject to 280E. So I think that's an important distinction to make.
Yes, for sure. Yeah, that term plant touching is a good one.
Do you have any other questions from the group?
Awesome. Oh, one other question. What would be the ideal contact to challenge the rules around 280E? Well, I would say challenging 280E is like around the vendor funding. So certainly there are a number of different tax court cases that revolve around 280E. The thing that I always come back to is not a single tax court case has gone the way of the challenger. Every single case has essentially gone the way of going back directly to, I'll just go back to this definition. It's almost always goes back to this piece of 280E, no deduction or credit shall be allowed. And so, you know, we've seen a number of different challenges to 280E, a number of different constitutional arguments. There's you know, some practitioners ask about whether they can use 471C, which is a cost allocation methodology that came about from the Tax Cuts and Jobs Act from 2017, that in theory could be utilized, but going back to 280E, there hasn't been a tax court case that specifically addressed that. I would just be very, very careful about about trying to challenge the rules around 280E. And honestly, I would just wait until this whole rescheduling piece is resolved, which hopefully will happen in the next couple of years. Does that answer your question? Got it. Okay, great. Anybody else? Great. Well, thank you. Thank you so much, everybody. Please feel free, if you have any other questions, feel free to email us directly. Our address is just mark@moremwaller.cpa, Betsy@moremwaller.cpa. Katie, who's on the call here, she's at hello@moremwaller.cpa. Please feel free to shoot us an email. Reach out to us on all of our different channels. moremwaller.cpa is our website as well. We have an Instagram that we check and make sure that we respond to messages there. So please feel free to reach out. We're happy to help.
Thanks everyone for attending.
All so